The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and Ben Boulos, and these are your headlines. US President Donald Trump ramping up threats to target Iranian civilian and energy infrastructure unless a deal to reopen the Strait of Hormuz is struck by tonight.
We're giving them till tomorrow, 8 o'clock Eastern Time, and after that, they're going to have no bridges, they're going to have no power plants. Stone Ages, yeah.
And maybe the world will have no oil because oil prices rise on Trump's latest escalation. You've got to remember these are futures prices, the spot being even higher than that. But equity markets remaining composed with European futures hovering around the flat line as equities return to trade following the extended close.
The CEO of Danone says the food giant is entering a new phase following a wave of acquisitions, including UK brand Huel, telling CNBC exclusively the company is positioning itself in the face of potential volatility.
It has an impact on inflation, it will have an impact on interest rates. This is where brands that matter to the people, brands that people would miss if they were not around, matter. So this is the time where you need to keep investing behind the brands.
The crew on board Artemis II flies deeper into space than any humans ever before. Their survey of the far side of the moon seen as a critical stage in NASA's mission to return to the moon.
Well, good morning, everybody. It's good to be back after the Easter break, even if the news flow remains suitably glum. I want to explain something to all of you just before we get off into the rest of the show, because I think you need to realise that what you see on the Brent and WTI price is only half the story. If we can get those prices up, here we go. Look, now some people are saying, well, hang on a second, WTI is trading higher than Brent. What's going on there? Well, these aren't actually the dated prices of the contract. These are futures contracts, okay? So look, June, people are hoping for the Brent contract that things will abate by then, hence it's trading at 111. May is a nearer term contract for WTI, which you can see there, hence the price is higher. But actually for dated Brent, i.e. if you've got a cargo assigned delivery date, prices in the last 72 hours have been as high as $141 per barrel. So don't be confused or don't be naive that these futures prices, the June contract and the May contract for the oil you can see on the screen, is the actual price if you, your Asian importer, or B, the European importer, or anyone else wanted a dated delivery date in the next few weeks. The price is a lot higher. Okay, just so we're all aware of that. This is only a gauge. It's only one price. A bit like the VIX is only one measure of volatility. Okay, let's move on. US President Donald Trump's latest deadline for Iran is just hours away, with the US leader reiterating on Monday that Washington will strike critical infrastructure across the country if Tehran does not reach a deal and reopen the Strait of Hormuz by 8 p.m. Eastern time tonight.
This is a critical period. They have a period of, till tomorrow at 8 o'clock. I gave them an extension. They asked for an extension of 7 days, right? I said, Steve, give them 10 days. 10 days is up actually today, so I gave them 11, I guess, indirectly. I thought it was inappropriate the day after Easter. I want to be a nice person. They have till tomorrow. Now, we'll see what happens. I can tell you they're negotiating, we think, in good faith. We're going to find out. We're getting the help of some incredible countries that want this to be ended because it affects them also. A lot of people are affected by this, but we're giving them till tomorrow, 8 o'clock Eastern Time, and after that, they're going to have no bridges, they're going to have no power plants. Stone Ages, yeah.
The problem is, Mr. President, if we have no bridges and no infrastructure and no power and no petrochemicals coming out of Iran, we probably have no LNG, helium fertilizer, and oil coming out of that area as well. So we're all going to be in a bit of a pickle. Anyway, Iran has rejected the idea of a temporary ceasefire, calling instead for a permanent end to the conflict. Dan joins us now. Dan, why do you think, I don't know if you have a view on this, everyone seems so sanguine and so relaxed in market world, given this incredibly binary scenario for 8 p.m. Eastern time?
Right, Steve. And just to add to what you were saying before with regards to the elevated risk premium that we're seeing in oil right now, it's not just the front month contracts for both Brent and WTI that are holding above $110 a barrel or nearabouts. It's also the Middle Eastern sour blends that are really popping right now as well. And if you take a look at something like Dubai and Oman, for example, these have also been trading at premiums for the last couple of sessions and indeed the last couple of weeks, as markets attempt to price what could happen next in this conflict. For example, Oman crude trading between $118 and $120 a barrel, again a primary risk barometer for the region right now. And then also taking a look at Dubai crude trading between $117 and $125. So what we see right now is this sweet sour spread being inverted, meaning these heavy and sour grades are trading significantly higher than the lighter Brent benchmark due to localized supply desperation. Remember, typically we see Dubai and Oman trading at a discount to Brent. Today they're about $7 to $15 more expensive. And on the front month contracts, as you were referring to, Steve, oil holding above 110 a barrel this morning. And the reason is pretty simple. Markets are not pricing in a deal. If traders believed that Iran and the United States were close to an agreement to end this war and to reopen the Strait of Hormuz, you probably would have seen crude sell off by now, but that hasn't happened. And in fact, some Wall Street desks are still running models that put oil at $200 a barrel if this conflict extends. So all eyes now on 4 a.m. Gulf time Wednesday. This is President Trump's deadline for Iran to reopen the strait or face what he is calling complete demolition of the country's power plants, bridges, and energy infrastructure. And what's also interesting, just to add another point on this, the deadline might actually hold this time, because at the White House briefing overnight, Trump said it's highly unlikely he moves it again. Now, of course, for traders who have been burnt by these taco moments before, that might be the most important line out of Washington in the last 24 hours. In fact, here's the president speaking earlier. Take a listen.
We have a plan, because of the power of our military, where every bridge in Iran will be decimated by 12 o'clock tomorrow night, where every power plant in Iran will be out of business, burning, exploding, and never to be used again. I mean, complete demolition by 12 o'clock. And it'll happen over a period of 4 hours if we wanted to. We don't want that to happen.
Important to say that Trump did say these talks are going well and that he does have an active and willing partner on the other side. But Tehran is still flatly denying that any direct negotiations are happening and actually called Washington's position at this point one-sided and unreasonable. Iran put forward its own counter-proposal through Pakistani mediators. They want a permanent end to hostilities, a safe passage protocol for the strait, and the full lifting of sanctions, but Trump rejected that as well. So the talk on the trading desk this morning is, will we see a last-minute deal? Will we see the president taco trade this once again and extend the deadline, or will Trump actually follow through and decide to hit critical infrastructure inside Iran and push forward with a major escalation of this conflict? We don't know the answers to those questions yet. It's back over to you, Karen.
Dan, thank you. Terrific summary. Let's take a look at the markets and the reaction we saw for that Easter Monday trade on Wall Street. Positive is the trade. Again, hopes that we may see some de-escalation. That is, again, one of the big hopes out there. And you can see 0.5% up on the Nasdaq. The Apple, one of the big trades that we saw in session yesterday. Big drivers there. Also across on the Asian markets today, a Samsung in focus. So again, a technology tilt to the markets. We saw a forecast from Samsung around a record quarterly profit forecast. And that, again, don't forget the big drivers for the South Korean market. It's been the likes of the Samsung and SK Hynix around the memory chip crunch. So that news flow coming through, and you can see the South Korean market is trading high, almost 1% firmer at this stage. Japanese stocks 0.2 in the green, so firmer territory, not the same though as the leap we're seeing out of those South Korean markets. We're ex-Hong Kong today, not trading today, but you can see the Nifty 50 in India a little bit weaker. In terms of European markets, this is how we're gearing up for the trade. Markets have more news flow too. Don't forget, we're gearing up for the IMF World Bank annual meetings next week. Already some suggestions in a blog post that we may be seeing a downgrade to the economic growth story. This is being flagged by Kristalina Georgieva, the managing director of the IMF, talking about the impact so far of the conflict and what that could do to the growth trajectory, which looked like it might have been upgraded, but instead now we're talking about some downgrade figures potentially. That outlook, the World Economic Outlook due on the 14th of April. So markets, again, anticipating what that could be telling us. But so far this morning, futures indicated just slightly ahead. And to the US boards, what Wall Street is indicating looks weaker today, suggesting that a give back of some of that Monday trade from yesterday, Steve.
Yeah, thanks very much indeed for that. Okay, Jamie Dimon, the CEO of JP Morgan, has warned that the Iran war could trigger significant commodity price shocks. Thank you, sir. We weren't aware of that. I mean, we did know, didn't we? Let's face it. So did Jamie. Rising sticker inflation. Thank you, sir. And rates higher than markets currently expect. Thank you for that as well, sir. In his annual letter to shareholders, Dimon described rising rates as, quote, the skunk at the party. I like that. That's interesting. That could cause asset prices to fall this year. Daniele Antonucci is the CIO at Quintet Private Bank, is with us now. Daniele, all of the above from Mr. Dimon, of course he's right. These could all be the main risk. But quite frankly, I don't think anybody can look beyond the latest ultimatum. It's like everything is emanating from this crisis. If the war ends, then we can get back to worrying about number 2, 3, 4, 5, 6 thing down the list, which include all those things Mr. Dimon mentioned. If the war doesn't end, there's no point in worrying about the other stuff because it's going to be so potentially enormous for the global economy and for investing as well. But tell me you feel differently.
That's right. So first of all, I think it's the right way to think about it. When I look at scenarios for investing for real portfolios, as you know, the rule number 1 is never ever put a forecast and a date in the same sentence. We cannot look beyond the next few hours. So I think about how the long-term strategy could be adjusted before these events. For example, I'm a long-term dollar bear. I think there's a de-dollarization process ongoing. It will last quite a few years. But near term, and we have seen some of it, the thing that people want when uncertainty rises is cash, and the cash they want is dollars. So I bought some of this, and so one implication is stay close and get closer to your long-term strategy. You don't want to be caught one side of the bet or the other one. That's one. And then there's the repricing we have seen in markets. Some markets have repriced quite a bit. Before you mention economic forecasts, think about bond yields. Bond yields have repriced from a lot of, or a few, depending on the region, rate cuts to a few rate hikes. So maybe there is a value in those.
Yeah, but I don't, to be honest, Daniele, and I hear what you're saying, and I agree with 95% of what you're saying, but I don't believe for 1 minute the bond market knows how to price future interest rates at the moment because we just can't work out all the other stuff as well. If there is a deep recession as well, I'm sure we're not going to get these rate hikes that everyone's worried about if this is just a short-term supply shock. And if the supply were to come on later on as well, and then there were a demand dent on the back of it, I can't believe that we would see 2, 3 rate hikes from all these central banks.
Well, precisely. But they have repriced. If there is a recession, then these bond yields will come down. But they have risen from the level they were at the onset of the conflict, precisely. And then we think about what type of shock it is, more near term. I quite agree, you can look past this deadline. Why we're focusing, or why markets are focusing on this particular deadline as opposed to the last one remains to be debated. But if you think about it, the initial impulse will be stagflationary. You have lower growth, you have higher inflations. Rate markets have repriced that. Other markets haven't. Spreads are still tight. They widened a little bit. So that's how I would approach this.
Great.
I mentioned earlier that we were waiting for the IMF to give us their latest WEO, their economic outlook, and there were some early indications that growth will be the casualty here, inflation will be higher. To your point about the long-term bond story and what we now start to price in, there is a view that we are setting up for a higher oil price for longer than one would have anticipated, that it's not just going to be a short, sharp conflict, that even if things get resolved, say tomorrow, which doesn't seem to be the scenario, we've still got an oil price that may be higher. How do we think about the blowback that that's going to have for the inflationary outlook?
Right, such a good question. I think we need to look at the ripple effect. It seems to me the first order consequences are widely understood. Lots of forecasters have revised down growth, inflation higher, no more rate cuts, but rate hikes. This is the first order consequences. They might be dire, by the way, if oil prices stay at the current level of rise further from here. But then you have second order consequences as well, the ripple effect. And that, I believe, is less understood. For example, you could say that oil exporters might gain and oil importers might be more under pressure. You might say that certain specific sectors, shipping, aviation, logistics, and insurance, perhaps also, they might be focal points. So there are several consequences that go beyond the simple impact of oil on growth and inflation, and we should be looking at this.
Daniele, there'll be some people tempted to pull the 2022 playbook off the shelf and look back to what they did then when we saw the price spike and the market sell-off after Russia's full-scale invasion of Ukraine. You're very clear that you don't see this as analogous to that. How do you see it differing, and how does that affect your positioning?
Right, so there's similarities, but there's also differences. First of all, what is similar, what we have seen is that in multi-asset portfolios, correlations are positive once again. So basically, equities and bonds during the conflict have moved in the same direction. That makes it quite difficult to mitigate risks. You don't have the right hedges in place. It's very difficult to find the right hedges. Think about gold, actually. It hasn't performed this year, but it did awesomely the year before. The difference is the starting point. So back then, interest rates were zero or negative in some cases. Inflation was much lower, was between 1% and 2%. The economy was overheated. Labor markets, there were labor shortages, for example. So that's the difference. Right now, interest rates are at the level that I would describe as neutral or maybe somewhat restrictive already. Inflation is higher. The economy, you wouldn't say it's so strong. Consumer demand, it's not booming. And stimulus. Remember that back then, fiscal stimulus, the US government was mailing checks at home to a lot of American consumers. Now that's not the case. So these are the differences, I think.
Daniele, before we let you go, I want to circle back to your first comment, Steve, about the long-term bearish view that you have on the dollar, because there's a lot of noise right now, and that clear dollar strength story is coming through in the middle of this conflict. But if there is a long-term story where dollar does get punished, how do we think about the implications for equity portfolios, for fixed income? I mean, how violent could that change be once we get through the conflict?
I think this dollar weakness will likely reassert itself in that scenario. So one implication, first of all, is that prior to the past couple of years, we stripped out currency effects to a much lesser degree. But now we do. Now we hedge a bigger proportion of our equities. Because of this dollar weakness, we are predominantly European investors, so if the dollar weakens, when you translate potential gains into a local currency, euro, sterling, obviously there is a negative effect. But what I meant before is that tactically, you need to look at this as well. We didn't want to be exposed to dollar strength in a scenario of this conflict continuing a while longer, so that's why we bought back some dollars.
Okay. Daniele, thank you very much. Daniele Antonucci, CIO of Quintet Private Bank. Plenty more still to come on the show, including AI demand and geopolitical tensions drive record revenues for China's chip sector. Plus, NASA's Artemis II mission makes history, sending humans further into space than ever before. And we'll bring you an exclusive conversation with the CEO of Danone. Don't miss those highlights and plenty more. That's coming up at 7:45 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. NASA's Artemis II mission has flown the furthest distance humans have ever travelled from Earth as they flew by the far side of the moon. The 4 astronauts on board spent 6 hours surveying the moon, with the mission being the closest trip to it since the Apollo missions 50 years ago. Meanwhile, back down on Earth, SpaceX has reportedly outlined details of its IPO with its bankers, including plans to host 1,500 retail investors at an event in June following its IPO roadshow launch. That's according to Reuters, which said the company reiterated its plan for a large portion of shares to be allocated to retail investors, with SpaceX CFO Brett Johnson telling those at the meeting that retail was a critical part of the listing.
Let's have a look at Samsung. The company has projected its first quarter operating profit will exceed its total profit for the entire previous year, fueled by demand for memory chips from AI data centers. The stock ticking up 1.6% currently. The projection nearly triples the company's previous record quarterly operating profit of 20 trillion won, which it achieved in the fourth quarter of last year. Well, Chinese chip firms reported record revenues last year, fueled by surging AI demand, driven by memory chip shortages and US export restrictions, with SMIC, the country's largest chip manufacturer, notching more than $9 billion in revenue for 2025. Arjun's been looking at the memory chip crunch, and the numbers today from Samsung just extraordinary.
Really are, and you're seeing some of the things that are supporting Samsung also playing through to the Chinese chip sector as well. You mentioned SMIC, this is China's largest chip manufacturer. Analysts expecting $11 billion in revenue this year, up from $9 billion last year. Huahong, another manufacturer, reporting record revenues in Q4. More Threads, which is seen as a competitor of Nvidia in China, seeing between 231 and 247% revenue growth. So extraordinary numbers. And what's been underpinning that, ironically, a lot of the time has been US restrictions on Chinese chip manufacturers. One, you were seeing a large demand for obviously AI-related semiconductors, but China's chip sector has been cut off for so long from Nvidia chips. It's been cut off from those. So the government has been pushing some of the local companies to buy domestic alternatives, and that's been supporting companies like More Threads, some of those companies to get those manufactured by companies like SMIC. And so you're seeing this sort of ecosystem being created as a result of China being cut off. And you mentioned Samsung there, very much the memory chip crunch, the huge price rises supporting some of China's homegrown memory players, the likes of CXMT as well. Again, high bandwidth memory has been really restricted from the Chinese market, and that's where some of those domestic alternatives are really stepping in.
The narrative from Samsung today is that the industry is unstoppable, that there's AI stories alive and well. But there was a warning from SMIC, which is just extraordinary, because this is, the Chinese company that is trying to provide resilience against international supply chains. And it's warning that effectively there's been breakaway spending on artificial intelligence, that 10 years demand has almost been brought forward in a couple of years, and that some data centers may be sitting idle. What sort of messaging do you think is coming through from the Chinese here?
I think it very much depends on where you're looking. China has approached the AI build-out in a very different way, I think, to what we've seen in the US. Where in China, I think it's been a lot more disciplined, given constraints on capital, for one, given constraints on technology as well. So you're seeing a lot more of a cautious approach. You're seeing things like open source models. You're not seeing the large spend you're seeing over in the US. In the US, you're seeing huge demand. Those infrastructure continue to be built out, and you're seeing that, I think, in Samsung's numbers. There's a huge shortage of certain components. One of those is memory, leading to this huge price rise because of the shortage, and that's really supporting, I think, Samsung, but also it does underscore some of the broader demand from the US players. China is having huge demand, but I think the approach is very different.
Makes sense. A great explanation. Thank you so much, Arjun. And for more on the story, you can read Arjun's article at cnbc.com.
We have had a flurry of private credit news since European markets closed for the long Easter weekend. Here's what you need to know. Shares in Blue Owl closed at a record low on Monday, continuing last week's losses after it announced it will limit redemptions from two of its private credit funds due to a surge in withdrawal requests. Investors in the company's $36 billion Blue Owl Credit Income Fund asked to pull more than a fifth of shares in the first quarter, up from just over 5% in the last quarter of 2025. Meanwhile, the JP Morgan CEO Jamie Dimon has warned that private credit losses could be larger than expected amid weakening lending standards. In his annual letter to shareholders, Dimon said he reckons that lending from private credit funds to heavily indebted companies is worth just shy of $2 trillion, and not everyone providing credit is necessarily good at it. But in a more bullish signal, Goldman Sachs announced that redemption requests at its own private credit fund defied the wider sector surge, coming in at just under 5% of shares in the first quarter. Goldman said the health of the broader industry remains strong and that default rates continue to be low across private credit markets.
Bill Ackman's Pershing Square Capital has offered to buy Universal Music Group in a cash and stock deal. That would value the company at €30.40 per share, with shareholders receiving nearly €9.5 billion in cash. That is a 78% premium to the company's stock price. In a statement, Ackman said the UMG's stock price has languished due to a combination of issues that are unrelated to the performance of its music business, which can be rectified by the transaction. You may recall that the company was looking at a stock market listing stateside. It had in March really put those plans on hold, citing market uncertainty. And of course, as we talk about the Middle East situation, that uncertainty continues for a lot of companies in terms of their various different company plans, but also a business that's been working on its revenue stream. It has a new streaming 2.0 agreement with Spotify and Alphabet YouTube in 2025. It was trying to basically advance its super fans, dedicated listeners through that channel. Of course, as you come up to listening or any sort of transaction here, the revenue picture, incredibly important.
Shares in Universal Music Group called up 40% on TradeGate after the offer for the company.
Yeah, and investor webcast happening at 10 o'clock Eastern time today. And looking at the details, it looks like the Pershing Square offer works out cash and stock estimated to be worth $30.40 a share, represents a 78% premium to Universal Music Group's current stock price. So those details just breaking in the last hour.
Yeah, a lot of content deals going on. We've been talking a lot about the movie aspect, television in recent weeks, but music, of course, a key part of content of the future too.